Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Europe podcast. Good morning. It's Wednesday, the 1st of October. I'm Caroline Hepker in London.
And I'm Stephen Carroll in Brussels. Coming up today, out of time, the United States government shuts down for the first time since 2018.
President Trump threatens to permanently fire a lot of federal workers as markets assess the impact of the US funding lapse.
Plus, shaping the future of finance and beyond, we delve into the topics at the heart of Bloomberg's Women, Money and Power event in London.
Let's start with a roundup of our top stories.
The United States government has entered its first shutdown in nearly 7 years as Democrats and Republicans remain in a standoff over spending plans. At issue is whether to attach healthcare and other policy changes demanded by Democrats to a stopgap spending bill to fund the government. The deadlock now threatens to paralyse many US government operations while suspending key services for Americans and paychecks for federal workers. With more, here's Bloomberg's Miles Miller.
National services are going to be disrupted. Everything from passports and visas on hold to federal oversights of the markets and workplace complaints as well. We also won't get our economic data in a timely fashion. The Labor Department's jobs report scheduled for Friday won't be released. Inflation and GDP updates are also frozen, along with many Treasury tax functions. That means that the Federal Reserve and investors are going to be basically flying blind without economic data. And we'll see how long this goes for.
Miles Miller was speaking as Bloomberg Economics calculated that if the shutdown lasts for 3 weeks, the unemployment rate could spike to 4.7% from 4.3% as furloughed workers are counted as temporarily unemployed. Much of the economic impact from a government shutdown has historically been recouped after it ends, but not all. The Congressional Budget Office estimated that the US economy failed to recover $3 billion of the $11 billion lost in output during the last shutdown.
Well, this shutdown came into effect hours after President Trump said his administration could use the shutdown to conduct mass layoffs of federal workers. The Congressional Budget Office estimates about 750,000 federal employees will be furloughed each day that the US government is shut down. Speaking to reporters next to Air Force One, Trump suggested mass layoffs as he linked the standoff over healthcare funding to immigration.
Well, we made you a lot, and that's only because of the Democrats. And as you know, they wanted to be able to take care of people that have come into our country illegally, and no system can handle that. And so we're totally opposed on that. But we can't take it. We just can't do it. I'd love to do everybody. I'd love to do the whole world. But our country can't handle people that come into our country illegally.
That was President Trump speaking to reporters as Democrats and Republicans have shown no signs of resolving their deadlock.
Traders are becoming increasingly concerned over the effect on upcoming data releases. Speaking moments after the shutdown took effect, Morgan Stanley's senior global economist Rajiv Sibal says the impact on the flow of economic information is a real concern.
The delay in the release of data is going to be critically important here. There are historical precedents that have seen data sometimes released during government shutdowns, sometimes not released. In this case, the BLS has gone ahead and stated that they will not be releasing the data. And as is important for investors in understanding what's happening in the economy, without that information, there's going to be a lot of uncertainty. And we're in an environment where we've had consistent growth, upside surprise, and the market is looking for more of that. And so I think, not having non-farm payrolls, not having retail sales could be, a bit of a wobble for markets.
Rajiv Sibal's comments come after recent economic data has shown the labour market is slowing down in the United States while inflation remains relatively under control, though still above the Fed's 2% target.
Now, in terms of the market reaction from the shutdown impact, S&P 500 E-mini futures currently down by 0.4%. Nasdaq futures are also declining 0.5%. European stock futures, meanwhile, are positive in the green. Gold has hit another record high, extending the 4-day rally we've seen. So bullion edging higher 0.2% to trade at $3,868. The dollar itself is currently off by 0.1%. Asian shares are also low, with China and Hong Kong closed for a holiday. That is the key reaction in markets and the impact from the government shutdown in the US.
In other news, Pfizer has won a reprieve from the US president's threatened tariffs on the pharmaceutical industry. The drugmaker agreed to cut some prices by up to 85% and sell directly to the public in the US. The pledge addresses Donald Trump's complaint that Americans are paying more for medicines. Here's Pfizer's CEO Albert Bourla.
For years, other rich nations refused to pay the fair share for the medical innovation. And as a result, Americans had to assume disproportional cost on their shoulders. This situation, we all knew, is not sustainable.
CEO of Pfizer Albert Bourla speaking there alongside Donald Trump in the White House. The deal secures the company a 3-year grace period from the anticipated pharma levies, with other major drug makers expected to follow the move.
Now here in the UK, Prime Minister Keir Starmer has attempted to quiet speculation about his leadership and take the fight to his opposition during a keynote address at the Labour Party conference in Liverpool. He took aim at the poll-topping Reform UK party for its, quote, politics of grievance, and referred to its leader Nigel Farage as a snake oil salesman. To an audience waving flags, he concluded the speech with a rallying cry to progressive patriotism.
I believe Britain can come together, that we can pursue a shared destination, that we can unite around a common good. That is my ambition, the purpose of this government. End decline, reform our public services, grow our economy from the grassroots, and with resolve, with respect, with a flag in our hands, we will renew this country until we can say with total conviction that Britain is built for all.
MPs and delegates told Bloomberg Starmer was in a more comfortable position after his speech than he was at the beginning of the conference, buying his government some time to consolidate its position. Bars in the immediate vicinity of the conference told Bloomberg that they had sold out of champagne. However, a UK indicator of business confidence has fallen to a record low. The Institute of Directors Economic Confidence Index gave its lowest reading since 2016 as business leaders ready themselves for potential tax rises in the Chancellor's autumn budget.
Research from McKinsey says women will control roughly 38% of investable assets by the year 2030, close to double last year's total. The shift will be discussed during Bloomberg's second annual Women, Money and Power conference in London today, featuring some of the most influential voices from across the global finance industry. The agenda covers issues including the future of investing, real estate and private markets. Ahead of attending the event, Diane Schrader, founder and CEO of Impact Investing Group, The New Climate, said opportunities in her sector are growing.
People in Europe, and particularly in the UK, family offices and the like, are wondering how to participate in this. There's going to be tremendous investment opportunities. And so they just want to be more connected. And I think with our climate salons, the way that we bring together these conversations and, some examples in such of areas of investment, I think that that's really helping to move this forward.
That's Diane Schrader, founder and CEO of The New Climate. Speakers at today's conference include Jenny Johnson, the President and CEO at Franklin Templeton, Ariane de Rothschild, CEO of Edmund de Rothschild, and Julia Hoggett, CEO of the London Stock Exchange.
So in a moment, we're going to bring you more on the US government shutdown and how markets are reacting to it. But before we get to that and our big conversation, something else that we've been focusing on this morning, some luxury butter with a luxury price tag, Stephen.
Yeah, our colleague Christina Peterson has been writing about a craze among Americans for Animal Farm creamery butter made in Vermont. Extra creamy cultured butter. The price $60 per pound, or £45 or €50. Around 14 times the average price of butter in the United States. But what I found fascinating about this is essentially what they're buying is European butter, or butter that you and I can buy in the supermarket every day of the week. It has a higher rate. This part I didn't actually know. So European butter must have at least 82% butter fat, whereas American butter must have a minimum of 80%. So already the taste is different. But essentially this is, I love buying fancy butter, frankly, but the idea of paying $60 for it is outrageous, frankly.
I think this goes into the camp of the little luxuries for maybe, the 1%. I don't know. I did have a look, actually, at some fancy butter. There is such a thing also in London. £8.45 at La Fromagerie, which is this, the high-end chain of cheese shops that focuses on all things made from milk. To me, I didn't realise that there was another kind of butter. But look, I thought it was, an interesting story, isn't it, about what luxury food is all about, even as food price inflation in the UK is surging. Ouch.
Yeah, but it was not quite to those levels, though, which I think is probably a relief for everyone concerned. I did start to look up some of the statistics around this. France is the number one consumer of butter globally, and in Europe, the biggest producer is actually Germany, followed by France and Ireland. So there you go, some butter facts to take with you through your day. Let's bring you more now on the federal government shutdown in the United States. Funding expired just after midnight Washington time, or 5 a.m. in London, after Democrats blocked a Republican stopgap funding package which didn't meet their demands. A little earlier, we spoke to our senior US government editor, Derek Woolbank, and started by asking him if there was any progress towards a deal in the hours running up to the deadline.
Almost none. The Republicans and Democrats are at a pretty big impasse. Democrats want additional money for health care. Republicans want to have just a straight-up clean spending bill extension. There's a big absence of trust between the two right now, particularly over Donald Trump's moves to aggressively cut the federal expense sheet without real consultation with Democrats. And so this has been a sort of series of red lines that have been crossed. And I would say, thinking specifically to that question, we have, sometimes you look at the last couple of hours and you see people lobbing ideas back and forth, and it looks like things might be going forward. Really not the case here. The last couple of hours was marked by the president sharing social media memes, absolutely trashing his Democratic counterparts. So that's really kind of where we sit right now. A lot of acrimony in Washington right now. Government shutdown has started. It's unclear how long this is going to go.
So what happens now to U.S. government operations?
Well, we begin the process of shutdown, and this is a little bit of a tricky thing, right? Because the U.S. divides between essential things that need to get done and stuff that's deemed non-essential. Basically, think of it as about a 60-40 split. Essential things would be like veterans hospitals. You're not going to kick sick people out onto the street. The military, things of that nature. But a lot of government workers are going to get furloughed, which means that they are going to be sent home, told not to work, told not to do anything, and to come back only when funding kicks back in. Those who are still on the job won't get a paycheck until all of this is done. And that starts getting really significant really quickly, because once you start missing paychecks, you're starting to talk about, members of the armed services and making their mortgage payments. And it gets really serious really quickly.
And that's the political jeopardy here as well. What does it mean politically for Donald Trump, but also for Democrats?
Well, I think that's a real key question. I think nobody really knows the answer. Some polls that I saw ahead of the shutdown were suggesting that there was going to be a bit of a pox on both their houses, with maybe a slight lean more towards blaming Republicans. But let's see what that looks like a week into it, 2 weeks into it, if we go, that long or longer. The other thing that I should say here is that shutdowns are not like, there's always this tendency to sort of say, okay, who wins, who loses in a political context, but it's not really a boxing match. You can't kind of score it like that. One of the things that I would note is that there have been prior shutdowns that Republicans instigated where they just flat out lost the shutdown, according to everyone involved, had to crawl back, pass a funding bill, getting nothing that they wanted, and then eventually went to win the next elections at hand, a year later. So that has happened before. So it's not like there's necessarily a one-to-one relationship here. Some of this is about, trying to make your base more enthusiastic and gin that up, but really a lot of this, and where the big worry is for both sides, is that independent voters generally just want the government to get on with the business of doing things in a sensible fashion, right? And the shutdown is basically the antithesis of all of that. Okay, so the thing is, what is the path from here? I mean, Republicans control both houses of Congress. They control the White House, but they do need some Democrats. What is the path forwards? Yeah, that's right. And the math is really straightforward. Republicans need 7 votes. That adds to 8 because Rand Paul, or Kentucky Republican, tends to vote no on these things. The last vote they got 3 Democratic votes, which is actually an improvement because the time before that, they only got 1. So there's been a little bit of movement there. But you're still sitting there talking about, I need about 5 more Democratic votes if I'm Republicans. That does get to be quite a challenging task. I see this going kind of one of 2 ways right now, just looking at the options on the table. The first way is Republicans and Democrats do actually have an exit ramp if they wanted to start talking about healthcare subsidy money that Democrats want. There's a possibility that you could get some deal where Democrats agree to a short extension while serious talks are ongoing. That's one path. The other path, quite frankly, is someone caves and just gives up. And both of those things are ways that we've seen shutdowns resolve previously. Those are really the 2 big things right now. And as I say, walking into this shutdown right now, that road has been papered by, just straight acrimony between the 2 sides, and it's a lot of tension right now. So, let's see where we go. But those are the 2 most obvious ways out, if there is going to be a way out that either side wants to actually take. Well, that was our senior U.S. government editor, Derek Wallbank, speaking to us a little earlier. Well, let's think also about what this means for markets now and bring in our Markets Live executive editor, Mark Cudmore. Good morning, Mark. In advance of the deadline for the US government shutdown, we did see gold rallying to another record high, the dollar's weakening. What does the shutdown mean for markets?
In the short term, very little. It's a creeping story rather than a binary story for now. If it extends for many weeks, it can become a sudden binary story and really matter. So it's a creeping story. It does still matter, but how does that matter? It means largely a continuation of the trends we've seen. You talked about gold's at a record there, but you used the word another record, and gold's been making records all year. So it's just a continuation of that trend. It's a continuation of the dollar depreciation trend we've seen all year. Stocks should probably continue to do okay. The one that's interesting, I think, is that it's completely consensus, and that's been the precedent, that in shutdowns people buy treasuries. I'm a little bit more worried about the conclusion that time around. I think that'll be the knee-jerk reaction as a run to a haven, but treasury's haven status has been eroded over the past year, so that might be the trade that disappoints.
Where's the cliff edge then, Mark? Where does things get serious for markets?
I don't think people are sure on that, but you're talking weeks away. I mean, I thought it was very interesting. Bloomberg Economics made the point that it'll be pretty much irrelevant for 4th quarter GDP in the US unless it extends beyond mid-November. So they're basically saying economically it doesn't matter unless it's like we're talking 6 weeks or more. I think markets will start to panic before then. But, probably we could go a month before this becomes a binary cliff edge. Now, the point is you don't want it to get there, because if it does get to the cliff edge, these are markets that are not priced to be disrupted. These are markets where people are very extended in the consensus trades. So if we go off that cliff edge, it could be horrible. But we're a long way from that.
Yeah, OK. Well, talk to us a little bit more about the bond markets then, because we're reporting on bond traders putting money into options bets that 10-year treasuries are on the cusp of a significant rally. So how does that thread into your view on treasuries now?
Yeah, I mean, as I said, that's kind of the consensus at the moment, that this will be support treasuries. And it's supported by the fact that, the shutdown will have some short-term dynamics in terms of that it'll delay data or cloud, or undermine the data that we do get. And therefore, there's no chance to kind of disrupt the narrative that the administration is pushing, which is that inflation is under control and the US needs to cut rates rapidly. And that'll be facilitated at some point, because if you get a lot of furloughed workers who who then go on temporary job leaver status, you could get a temporary spike in unemployment rate, which would then help Trump put further pressure on the Fed. Now, of course, Fed officials would look through that theoretically, but if they're getting a lot of pressure, kind of going, oh my God, we need to cut rates dramatically, and then suddenly those interest rates those unemployment rates would fall back down after the shutdown ended. So this kind of all plays into the administration kind of hands, and that's why I understand why people are kind of going, hey, buy treasuries. The administration wants yields lower. It's the kind of consensus play here. I just feel it's very consensus, and everyone knows that the real problem the US has got is that it's got an inflation problem that it just can't get away from. We talk about we're at the end of the kind of disinflationary phase, and we're still sticky above 3%, really. So I don't think yields go massively lower, but even if there's a knee-jerk reaction.
Just on the question of the data releases being delayed, of course, Friday's jobs report in focus for that. I mean, how serious is that, or how much does that affect things in the medium term if we don't get that data for a while?
Medium term, not at all. I mean, no one can remember when we got delayed data before. You go look up in the precedent and go, oh yeah, that didn't come until 2 weeks later. Oh yeah, we didn't get the CPI report until 30th of October rather than 16th of October. And I was trading back during some of this time, you move on from it. It doesn't decide the medium-term future. From a short-term point of view, first of all, the Fed looks through all these delays and stuff and looks all through all these temporary problems, as long as they stay temporary. And that's why I said there is a cliff edge, but it's not close. As long as temporary, they look through it. Probably the other thing is we overreact to other alternative forms of data, of which Bloomberg provides a lot, and private forms of data. People aren't used to looking at these data resources, so their algos, their programs, their models, their spreadsheets aren't worked to trigger off them, which causes a little bit of disruption and kind of unnecessary short-term volatility. But again, not medium-term. So everything is important. This is ultimately going to be a short-term story that consumes us for a couple of weeks, unless it passes some binary tipping point. And as I said, that binary tipping point, we don't know when it is, but it's probably a few weeks away.
Mark, great to have you with us. Thanks for your analysis. Our Markets Live executive editor, Mark Cudmore.
Stay with us. More from Bloomberg Daybreak Europe coming up after this. Now, let's bring you another of our top interviews this morning. So this year has seen huge uncertainty in terms of trade tensions, fiscal policy, geopolitical risks. What does that mean for investors, for CEOs and philanthropists looking forwards? Well, this is at the heart of Bloomberg's Women, Money and Power conference today. When it comes to the energy transition, climate change continues to accelerate, even as the Trump administration has pushed to dismantle renewable energy projects and, as we've seen, artificial intelligence create power demands globally. Now, the New Climate is a group which has tasked itself with accelerating institutional investment into climate change technology. So ahead of the summit, I've been speaking to the group's founder and CEO, Diane Schrader, and been asking her what is on offer to investors who are interested in the climate space now.
I think that that there are opportunities everywhere. I think one of the things that we look at is, particularly on the energy side, is infrastructure. There's transmission, there's storage, there's all sorts of opportunities. And you'd mentioned wind. Europe is certainly a leader in this area as well. If you go back to nuclear, one of the things that the UK and the United States have done is they've agreed to share lessons. And I think that not only does this apply to nuclear, but I think especially in private markets, this applies to all of the areas of energy, where we can go into new frontiers and then share the lessons of those early pioneering projects such that we can standardize and expand on those. That's tremendously important. And again, we've seen this already in solar. We've seen this in wind. We're seeing this in storage. We'll see this as, again, we go further into nuclear, enhanced geothermal and such.
You've just finished hosting your National Security Salon event, which has been looking at the intersection between climate, national security and these institutional investors and investments. You had, I think, something like $13 trillion in terms of assets under management, being managed by the attendees. Did you get the sort of buy-in that you'd hoped for from that event?
Oh, it was absolutely thrilling. We've been hosting the Climate Salon for 8 years. And I had been saying that peak salon was in London going into the Glasgow COP going back in 2021. We had about 11 trillion in assets under management at that salon. And if you look back at the trends, there was tremendous interest in climate, not only from governments, from corporations, from banks, and certainly from institutional investors. And so this year, as you had said, there are some kind of policy headwinds in the climate area. And so it was surprising to us to see so much interest in this particular intersection. Again, it goes back to the fact that a lot of this is focused on infrastructure, and these are very big ticket items. And so it takes institutional investment to drive it forward.
I suppose there's a lot of attention also on the China model, effectively, which is not either or, but and when it comes to renewables and the carbon economy. Do you think that others are taking lessons away from that strategy that is evident in China?
There's a tremendous discussion about China at Climate Week that I just attended last week. And I think that a lot of folks are saying that here in the United States, we're really good at inventing from 0 to 1, and China is great from 1 to 2. And if you look at where they've gone in their investments in innovation in climate, they're just doing an exceptional job of scaling and replicating and standardizing these opportunities. So I think there are a lot of takeaways and such from China that we could replicate in other places for sure. I would like to see us share, more of these technologies and again the information and such from them. But it's inspiring. It's inspiring to see.
The biggest obstacle that you think is standing in the way of harnessing institutional investment for climate purposes right now?
It's always product. Institutional investors see a lot of opportunities, but they have very strict requirements in what they invest in. And so what we need is to provide them more opportunities that fit their strict criteria. They have long-term obligations to meet. At the same time, they're also looking at some of their shorter-term needs as well. And so it's always just advancing more product. And that means getting some of these small to mid-range opportunities up to the scale that institutional investors need.
Diane, in the summer, you were in the UK with an event, and there was a lot of focus on national security and energy, especially for the UK.
We hosted a series of dinners with institutional investors during that time, and it was interesting. One of them focused on this area of climate and national security. And the big question, particularly there were family offices at that dinner, wondering whose national security. So if you go back to June, and there are all these conversations, of course, around how NATO countries are going to participate more in investing in national security. A lot of that innovation does come from the United States. Certainly not all of it, but a lot of it does. And so I think a lot of people in Europe, and particularly in the UK, family offices and the like, are wondering how to participate in this. There's going to be tremendous investment opportunities. And so they just want to be more connected. And I think with our climate salons, the way that we bring together these conversations and, some examples and such of areas of investment, I think that that's really helping to move this forward.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.